Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Optimus Play. And this week we've been off to a interesting start with Apple's developer conference yesterday. A lot of um, anticipation around Apple's use of AI in their new iOS 18. However, despite making kind of some of the expected announcements with integration of ChatGPT into Siri, Apple only spent about 2 minutes of the entire 45-minute presentation on AI, and investors seemingly were not particularly impressed, somewhat disappointed. You had Apple down about 2% yesterday. Pre-market is down even further, trying to drag the S&P and the NASDAQ lower as of today's open. But, all eyes are now going to be focused on CPI print tomorrow, FOMC meeting tomorrow, on Wednesday, and more importantly, the dot plot in terms of expectations for rate cuts for the rest of the year, whether we're going to get two rate cuts or one rate cut. It seems like markets are continuing to move towards one rate cut at the moment, which certainly is a headwind for equities. So let's take a look at what the charts are showing us in terms of our outlook. So as you can see, the S&P 500 continues to make a higher high in terms of price, but one of the things that we keep noticing is that we lack higher highs in terms of momentum. So we lack this momentum here to the upside. We're seeing signs of exhaustion. These are not particularly good signs that you typically want to see as equity markets make new highs. You want to see confirmation in order to have more confidence that these highs will continue moving forward. It doesn't mean that it can't continue to grind higher like it has. We certainly have seen this go on in the past where we make higher highs in price, but we no longer make higher highs in momentum. And this can go on for quite some time before you get a bit of a correction. So we're kind of back in this mode right now where we make higher highs in price, lack of momentum here, lack of confirmation. But this is something to be aware of. We see the same thing on the NASDAQ 100. We've made a higher high in terms of price, no longer confirming a higher high in terms of momentum. What's interesting here, I think, is the fact that you have the two major indices making new higher highs, but you see the Russell 2000 actually making new relative low. So this is a bigger divergence that we haven't seen in quite some time, where small caps are actually making relative lows while mega cap are making relative highs. And that divergence also is not particularly good. You want to see broad participation on the equity rallies as you see the equal weight S&P 500 index trading sideways as S&P 500 makes higher highs. That means you have a lack of participation. You have less than 50% of all stocks that are trading above its 200-day moving average. That's not a particularly good sign when equity markets are trading at all-time highs. So these are all warning signals. These are all things that are not particularly strong for a market. However, like I said, these types of scenarios or these types of situations can continue on, meaning they can continue to grind higher despite these lack of participation, lack of confirmation of these higher highs. So, we're in this kind of difficult position as traders because it's hard to fight the overall trend that clearly is bullish, but it's very clear that the market internals, and if you look at the things underneath the surface, things don't look particularly strong. You do continue to see growth outperform value here over the past year. We continue to see small pockets of value outperforming growth. But as you can see recently, we have that continuation of growth outperforming value in the current scenario. We have commodities sold off pretty heavily here over the last week or so, bouncing back a little bit. We have seen oil prices stabilize a little bit. We saw gold prices stabilize a little bit, and that's part of what's driving commodity prices a little bit higher over the past week or so. But overall, as you can see, the trend here for commodities is starting to slope lower. You see the outperformance of commodities relative to the S&P 500 has given all of those outperformance gains back. So commodities no longer an asset class that's outperforming equities at the moment. If we look at bonds, HYG, high yield corporate bonds, still trading in this range here, hasn't managed to really break out here. You had this one kind of, call it a false breakout that didn't materialize. So bonds giving us a more neutral view here rather than the risk on signal that we might be looking for here from bonds. You see the VIX still trading below the 13 level here right now, really speaking to the fact that volatility expectations over the next 30 days is relatively low relative to, what we've seen over the past year or so. We're pretty much in the bottom 10, 15 percentile in terms of volatility readings. So opportunity for options traders to be long volatility, but at the moment, not a whole lot to do from that perspective. You see the 10-year yield continue to moderate just shy of that 4.5% level, currently at 4.43. We continue to see kind of inflation print tomorrow likely tick down a little bit. That could potentially bring down rates expectations, but at the moment, I think that we're more likely to get a reading that's in line with market expectations, which probably won't be a big mover in terms of interest rates or equities for tomorrow, but this is one to keep an eye on in case we do get a surprise to the downside in terms of hotter or cooler than expected inflation. TLT, we talked about this bearish trend line here, the fact that we broke out above this bearish trend line, but notice over the past couple of days, we've kind of come back to testing that bearish trend line here. Is this going to bounce higher here and give us lower rates on the back of that CPI print? That could be one way to play this. Hard to say, but this is really kind of the risk reward certainly favors being long bonds here from where we are going into the CPI print tomorrow. You have the dollar index managed to break back above this 105 level. This certainly puts the dollar potentially higher here. Going forward, it has broken out above the 50-day moving average. 50-day moving average is sloping higher here. This does provide a more bullish view here for the US dollar going forward. Looking at gold, we continue to trade in this range between 2,300 and 2,450. Right now we're at the bottom end of the range. Like I said, gold is finding a little bit of stabilization here after what has been a choppy month, roughly 2 months of trading between this trading range. So at the moment, our base case is that we remain in this trading range. If we do see a breakdown here below 2,300, that would certainly potentially bring significantly lower prices down to the 2,150 level here as a downside target if we do break 2,300 over the next few trading days. So if you have gold assets or if you have gold mining stocks, this is one important level to pay attention to for gold. You see the spike here in oil here yesterday. Oil has certainly stabilized here. We're back to kind of in this trading range between 76 and 80 or so. That certainly is kind of the equilibrium here right now. That's our expectation, is for oil to trade in this kind of range. So energy shares will likely see a little bit of stabilization here as well. Oil has not kind of broken down below 76 and continue to move lower from here. So energy shares likely may stop some of the underperformance that we've seen here from energy. So looking at the sectors, this is really where there's not a lot of leadership from sectors at the moment. Technology certainly did not make a new higher high alongside the S&P 500, which is why I see a little bit of underperformance. Largely, I would say technology is performing on par with the rest of the market. Apple will drag this down a little bit here today. We'll see kind of how investors interpret Apple going forward a little bit, going out a week or two. I do think that overall Apple is taking a step in the right direction with regards to AI, but clearly they are behind their rivals. They're behind their peers. So it's not likely, in my opinion, in the short run to add to some outperformance here for the technology sector. Consumer discretionary has also not gone anywhere. It hasn't outperformed or underperformed. It's just trading basically on par with the rest of the market, which is not bad considering consumer discretionary is essentially near 52-week lows in terms of relative performance to the S&P 500. So perhaps we start to see a little bit of outperformance here from discretionary over the next few weeks. If we do see that, that would certainly be an overall positive for the equity markets because we do need to see some of these leading sectors to start leading in order for us to have more confidence in the market rally that we're seeing here right now. One sector that is leading is communications. As you can see, communications is one of the few sectors making a new higher high alongside with equities. So we do see strong outperformance here for communications, arguably the strongest sector over the past week or so relative to the S&P 500. On the flip side, you see financials making new relative lows relative to the S&P 500. This leads me to believe that, there could be some further weakness here going forward from financials, especially if you look at some of the smaller banks, regional banks, KRE index. That's really where I could expect to see some further weakness. We've gotten some news this week with regards to commercial real estate deals in Manhattan this week, showing kind of just how soft the commercial real estate market is right now. You have buildings trading at a 50 to 60% discount from where they were trading just a couple of years ago. And, you have a lot of regional banks exposed to those types of deals. So at the moment, banks outperforming in the past few months, started to show some underperformance here right now, I think is at risk of further downside. Consumer staples, trading mostly sideways from here. So not outperforming, not underperforming, not a whole lot necessarily to see here. Healthcare showing a little bit of outperformance here over the past week or so. Not quite enough to write home about just yet, but if we do see healthcare break out above this 148 level, then we could potentially see some interesting opportunities out of healthcare. Materials continues to underperform severely relative to the S&P 500. And this is really one that's concerning to me because materials, industrials, these are sectors that you should see leading as equities make new all-time highs. But these sectors are making new relative lows, and that's not particularly strong here for equity markets. You see that from both materials as well as industrials making new relative lows as the S&P 500 makes relative highs. Real estate also continuing to kind of underperform here right now. As you can see, this underperformance here has been pretty severe here over the past, year to date. We're down nearly 16% relative to the S&P 500, which is incredibly poor performance. Energy, as you can see, continues to underperform, but as oil prices stabilize, I think this could start to see a little bit more of a sideways drift rather than a continuation of that move here to the downside. So energy, I think, has had a pretty decent pullback here. This rallied from 77, 78 all the way to nearly 100, and we've retraced nearly 50% back, and that could potentially be an opportunity where you find a little bit of support here for energy. Utilities starting to underperform here as well. This was one of the sectors that was leading the markets higher here, but at the moment underperforming as well. Home builders also underperforming here. It hasn't broken this $100 support level yet, but as you can see, the relative performance here has made a new six-month low. So this is concerning to me that home builders could start to see this support level crack. You look at D.R. Horton, you look at Lennar, you look at Pulte Group, the three major home builders, they are at risk of breaking below very similar support levels on some of those charts. Semiconductors, right now trading basically on par with the rest of the market here. As you can see, it did manage to make a new all-time high at 240. Above 240 here right now. That hasn't been confirmed by the relative performance or momentum here. So not in my opinion, ready to chase this sector just yet, but we are seeing some small outperformance here from semis relative to the other sectors. So that's kind of a review of where we currently stand from a macro perspective. So let's take a look at a few charts in terms of opportunities here right now. One that I want to point you to is American Express. You see American Express on a very clear, strong bullish trend here. Recently pulled back a little bit, so the risk reward potentially favors adding some long exposure here. The risk reward fairly favorable, considering the fact that this is a stock that currently trades at only 18 times forward earnings. That's about a 10% discount relative to the S&P 500 from a valuation perspective. It's got decent margins, net margins of 14, 15%, and very strong EPS growth. We're expecting about 15% EPS growth, 9% revenue growth. That's well ahead of the average S&P 500 stock, both in terms of expected growth and margins that are roughly in line with the S&P 500. So the fact that it trades at a 10% discount relative to the market, I think, is the opportunity, especially on the small pullback that we've gotten here on American Express. The other one we still point to is Alibaba. As you can see, Alibaba has has kind of completed this bottoming formation here and has broken out above 78, traded as high as 90, and came all the way back to retest this level as support. So this is really where the risk to reward favors long positions. Your potential upside is fairly sizable relative to the amount of risk that you'd have to take if it breaks below that $78 level again. And the valuation here just looks downright cheap. You have to factor into, Chinese companies, generally speaking, trade at a discount just because of the geopolitical risks. They also trade at a relative discount because of, what are fairly, what's the right word, opaque financial accounting practices. And, balance sheets there are not as clean to read as US one. So for those reasons, these types of, these Chinese internet stocks do, even with all things equal, trade at a discount. But Baba trades at 9 times forward earnings. That's more than a 50% discount to the rest of the S&P 500. EPS and growth rates are basically in line with the rest of the market. EPS growth rate's about 8%. That's a little higher than the average S&P 500 stock. Revenue growth is expected to be about 6%. That's roughly in line with S&P, but it trades at about a 55, 60% discount to the S&P 500. So even when you factor into some of the discount factors that you get with Chinese internet stocks, it still trades a very, very, very significant discount to the rest of the market. So I think always worth taking a look at. And then also United Health. United Health has been, an outperformer relative to the S&P 500 for decades. It's for the last few years been trading in a very choppy sideways price action. As you can see, if you look at this chart, there isn't much of a trend here. It pretty much is very much sideways, but it is very choppy. And over the past couple of months, we do start to see a bit of a bullish trend starting to form here. But it really comes down to valuations. This United Health trades at about 17 times forward earnings. It has a strong EPS growth that's expected, about 13% EPS growth. That's well ahead of the S&P 500. Revenue growth about 7, 8%, which is a little higher than the average S&P 500 stock. Margins are relatively thin here. We're looking at about 4% margin, but that's why it's trading at a relatively low valuation at only 17 times forward earnings. So this is really one where the technicals and fundamentals look fairly constructive for over the past couple of months. Now, looking at some bearish opportunities here, you have Lind. This is a material stock. They do, gases and for different industrial applications. Recently kind of started this bearish trend, broke below this 435 support level, and has now retested this level 3 times as resistance. And I simply think that there's further downside, especially if you look at the relative performance of Lind relative to the S&P 500, incredibly poor. I think it's more likely that it's going to fail at that resistance level and trade lower from here. This trades at 28 times forward earnings. So that's about a 40% premium to the average S&P 500 stock. And when you look at the expected growth rates, they're not particularly strong. We're looking at about 9% EPS growth, which is a little higher than the average S&P 500 stock. But revenue growth is only expected to be 4.6%. So that's even lower than the average S&P 500 stock. So the only thing it's going for it is that it's got strong margins, 19% net margins. So I do think for those reasons, it does deserve to trade at a slight premium relative to the S&P 500, maybe at 22, 23 times forward earnings. But certainly, I think given the growth rates, it does not justify a 28 times forward earnings, which is 40% higher than the average S&P 500 stock. So when you factor into the technical level, 435 is resistance, and the fundamentals that look a little bit overvalued here, I think that's really where the bearish exposure opportunity lies for Lind. Um, Uber trades at 55 times forward earnings, so extremely high valuation. As you can see, recently kind of started this bearish trend, and every single time you get these small pops, they become opportunities to potentially short, and that's really what I'm seeing here right now. Especially if you look at the valuations, 55 times forward earnings. Now, those valuations are on the back of because EPS growth is expected to be incredibly high. Revenue growth is expected to be 16%, which is significantly higher than the average S&P 500 stock. EPS growth is expected at 47%, which is significantly higher than the S&P 500 stock. But it also trades at a valuation that's nearly 2.5 times higher than the average S&P 500 stock, especially when you consider the fact that Uber is barely profitable, net margins of only 3%. They basically spend nearly every dollar in potential profits on marketing and maintaining a market share. As soon as they stop spending on marketing, this is really where they risk losing market share. And that's kind of a tough spot to be in. And for those reasons, I think the fundamentals are risky, or rather the valuations are risky. And then you have a technical setup that seems to time quite well for bearish exposure here for Uber. And then lastly, looking at some opportunities in terms of outperformance and underperforming. One I want to take a look at is Freeport-McMoRan. Freeport-McMoRan, obviously the copper mining stock. This is one where even though it's been range bound here between 48 and call it 52 or so, as you can see, the relative performance has already started to break down below some of these support levels. So this is really at risk of potentially breaking below 48 and continuing lower. And then when you look at the valuations, trading at 30 times forward earnings, that's 50% higher than the average S&P 500 stock. EPS is expected to grow at a healthy clip of 10%, but revenue is only about 4.6%. It's got very thin margins of only 7%. So yes, EPS growth is slightly higher than the average S&P 500 stock, but when it trades at a 50% premium with such thin margins, I think this is really one where the valuations look too high, and you have a technical picture that starts to look a little bit weak, of potential weakness here ahead. And I think that's really where you get a bit of a bearish opportunity here. So that rounds out my views here for today. Gives you an idea as far as how we're looking at equity markets. Like I said, the divergence we're seeing between mega cap and small cap is concerning. It's not quite enough to be outright bearish on the market. It certainly is enough to be very cautious here on the markets. Things can turn around. We could start to see consumer discretionary materials, industrials, small caps start joining in on this rally. And if that does happen, that would be a full-on risk-on bull signal here for the equity markets. But until that does, we remain in a much more cautious view here for the broader markets. And hopefully this gives you some ideas to take a look at. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.